Hello and welcome to AI Accounting Tutorials. We are continuing our series on IAS 23. This is the part 4 of IAS 23 and I want us to look at a practice question on general borrowing. Is that okay? That is how to calculate borrowing cost eligible for capitalization when there is a general borrowing. Before we begin to look at the question, if you are new to this channel, kindly remember to subscribe to this channel. We have so many things to do together on this channel. Is that okay? Before we take the question on general borrowing, we've learned that general borrowing has to do with where funds are borrowed generally or for several purposes. And this borrowing could be the raising of fund internally from the capital structure of the business or entity. So this capital structure comprises of the equity component and the debt component. So if the business decided to raise funds from their debt component from their capital structure to finance a qualifying asset, this debt component, the source in which the money or the fund is being raised to form the debt component might be from different sources. Because of this, the interest rate and other borrowing costs, for instance, ancillary costs and others in relation to the fund may vary. Because of this, we have to use something we call capitalization rate in order to determine the rate to calculate the borrowing cost. So without wasting much time, let's go through the question and see how we solve this question. Ericus has commissioned a new piece of equipment to be constructed at a cost of $640,000. It is expected that the work will commence on 1st October 2020 and be completed by the year ended 31st May 2021. The cost will be met from the company's existing borrowing, which are as follows. Loan A of $500,000 with an interest rate of 6%. Loan B of $900,000 with an interest rate of 4%. Loan C of $600,000 with an interest rate of 8%. Calculate the amount of borrowing costs that Ericus Limited can capitalize for the year ended 31st May 2021 as per IAS 23 borrowing costs. As I said it earlier on, this question is on general borrowing, where the fund is raised from their internal debt. Okay, and this internal debt, the source of the money is from different source. Okay, so we need to calculate the capitalization rate in order to determine the borrowing cost. That is using the weighted average method. So the first thing we have to also take note here is the loan amount or the fund borrowed. That is $640,000, where different rates are given from different sources. Is that okay? So let's begin with the solution. So we look at determination of capitalization rate. That is the first thing we have to look at. All right. So to do this, first of all, we consider the loan and its rate. So we have loan A of an amount of $500,000 at 4%, 6% interest rate. We also have loan B of an amount of $900,000 at a rate of 4% from the question. We also have loan C of an amount of $600,000 at a rate of 8%. So this is the loan amount. Then we look at the interest on each loan, and all in what? Dollars. So when we multiply the interest rate by this loan, we will have 30,000 as the interest. The same way when we apply this on this, we will get 36,000 as the interest rate. We want to determine the capitalization rate. We multiply this by this, we will also get 48,000. I've explained this concept already, okay? Because the interest rate for the borrowed fund is many, we will not be able to determine which of them we should use to calculate our borrowing cost. Because of this, we find the weighted average rate of this borrowing in order to determine the borrowing cost. That is why we are trying to know the interest on each loan, then we try to find the weighted average. So we have to find the total of this loan where we have 114,000. We come to determine the total of the loan, which is $2 million. Is that okay? Now, in order to determine the capitalization rate, the general principle with regards to IAS 23 is that we divide the total interest rate by that of the total loan amount. So we have capitalization rate. Capitalization rate is given by interest, okay? The interest over that of the loan, the total loan. And we can testify that we have 114,000 as the total interest, total loan being 2 million. Is that okay? Because we are looking at this, we want the rate in percentage, we multiply it by 100. So the formula, we multiply it by 100 because we want the rate. Okay, and this will give us 5.7% as the capitalization rate. So we based on this capitalization rate to determine the borrowing cost for the period. So from the question, our main requirement or the main requirement is for us to calculate the borrowing cost that will be eligible for capitalization. Is that okay? So we want the borrowing cost. We've only determined the capitalization rate. Before we determine the borrowing cost, the first thing we have to consider is the commencement of the construction, and the commencement begins on 1st October 2020. So we talk of borrowing cost. When we talk of the borrowing cost, what we have to take note is that we have the interest rate already, that is the capitalization rate as 5.7% on the cost of the qualifying asset, and the cost of the qualifying asset from the question is $640,000. But remember that the construction begins on 1st October 2020 and ends on 31st May 2021. So this simply means that we have to calculate for 8 months from 1st October to 1st October 2020 to 31st May 2021. So that is exactly 8 months. So we calculate the 8 months, and this will give us 24,320. So 24,320 as the borrowing cost eligible for capitalization. Okay, so before we'll be able to even determine the borrowing cost, the time of the commencement of the qualifying asset is very important. Is that okay? And when it ends. But in our question here, in our case here, there is nowhere there is a suspension. Some question in the middle of the period, there is unforeseen circumstances that will interrupt the development of the qualifying asset where they need to suspend capitalization. I said this is the final part, but another time we may look at a question where which includes suspension provision for capitalization. So the period in which the qualifying asset begins to be in progress is very important, and where it ends. So basically, this is how we calculate borrowing cost eligible for capitalization for general borrowing. Take note that this is the borrowing cost eligible for capitalization. And this amount, when we want to record this in the statement of financial position, we add the borrowing cost eligible for capitalization to the cost of the qualifying asset, which is this. So meaning that we add this to this and recognize it in the statement of financial position. The process of adding this to this is what we call capitalization of borrowing cost. So this brings us to the end of this chapter. If you haven't subscribed to this channel, I will encourage you to do so, and also comment on this channel for us to know how this channel has helped you. Also share this video for others to also benefit from this. The more you comment on this channel for us to know how this video has helped you, actually motivate us to do more for you. Until we meet for our next video, I think it is bye for now. But then you can request for a special topic to be treated, either in financial reporting or financial accounting. So bye for now.